This recording is going to look at autumn 2018, focused particularly on the area of CAP1 finance, which was examined here for 12 marks. So the reason we picked this question is, one, it covers the area of CAP1 finance, and it was also the worst answered question in this sitting of the paper, which gives an idea that a lot of students are cherry picking and leaving out particular areas of CAP1 finance. So here you're asked to advise Albany on whether it should buy or lease the machinery. So it's a classic investment appraisal, kind of an advanced investment appraisal from CAP1 finance, a buy versus lease decision. And you're also asked, importantly here, watch that phrase, critically assess. So to highlight the word critically, means pros and cons. Critically assess the investment appraisal policy and suggest, so watch your and again. This exam technique, if you don't give both answers, you're going to limit yourself in the marks. 2 changes. So there's 2 elements to that question. In part C, you can look at your own. That's to do with the area of management accounting. What we're really interested in is the area of CAP1 finance. So we'll start off with the calculation around buy versus lease, and we'll then go on to critically assess the investment appraisal policy. So again, I'm assuming you've read through the question. If not, pause it and read through it and try and make an attempt at it. I'm going to walk you through how to approach part A now, the buy versus lease. So here we're told you're purchasing machinery $750. And they're going to fund it entirely through debt. So they're not sure whether they're going to borrow the money and buy it outright, which is the buy option, or the other alternative is to lease it for 5 years with annual payments at the beginning of each period. So highlight that. That means this is called a lease in advance. And what you're asked then to figure out is, should they buy it or should they lease it? So just to come back for a small bit of a recap in terms of buy versus lease. So in buy versus lease, you have 2 elements. The first thing is, do we need the equipment? And that's a normal NPV. Right, so this is not what we're asked here. We're assuming that they do need the piece of equipment. What we're typically asked in is the second stage is the buy versus lease decision. So that's your second step that we're looking at or worried about here is, should we buy it outright or should we lease it? And this is a particular type of NPV where you're only looking at the financing related cash flows, and the relevant discount rate becomes the cost after tax cost of debt. Is the after tax cost of debt. So this is a particular type of investment appraisal answered very poorly in autumn 18 because students just didn't focus on it. They focused on normal NPV, but they didn't look at the advanced areas like buy versus lease, sensitivity analysis, and asset replacement decisions, which are all advanced variations of NPV. So what we need to figure out then is, if we buy it, what are the financing cash flows? Well, if we buy it, the financing cash flows here, they are the upfront cost, the sale at end of life. So those 2 are pretty straightforward. The third one, where students don't usually get, is the cash value of capital allowances. That's the one that catches students. So when you buy outright an asset, you're able to claim capital allowances. And because of that, that will save you money in tax. And what we want to know is, what's the cash value of those capital allowances? And we'll show you how to calculate that in a second. For the lease then, the only financing cash flow you have will be the lease payment, net of tax. And why we do it net of tax is, lease payments are tax deductible. They're a relevant business expense, so you only want to look at them after tax, because that's the true cost to you. And what you do then is you lay out the financing cash flows for both alternatives, and you discount them at the relevant discount rate. Now, what a lot of students failed to spot in autumn 18 was, both are going to have negative NPVs, which is unusual in the normal NPV, but this makes sense here because we're just looking at the outflows. What you want to choose is the one that's least negative, because that is the cheaper alternative. You've already decided, remember, you want the equipment. Now you have to decide what's the cheapest way of financing it. So let's go back here then, and let's look at the buy option first. So your buy option here is $750 upfront. So in times 0, you're going to have minus $750. And because you own it then, your capital allowances you can claim 20% per annum. You cannot claim capital allowances unless you own it. So that means the cash flows here, if we lay them out for the buy option. So we'll say the cost up front, which is year 0, 1, 2, 3, 4, 5. Year 0, you're going to have minus 700,000. So that's pretty straightforward. Sorry, 750. And at the end of its life, it's going to have a 0 value. So we'll call that the disposal value. You don't have to put it in really, it's 0. So it's immaterial. You're not going to sell it for anything at the end. What we also have to put in then is, well, yes, I buy that up front, but the fact that I spend so much money, I actually get to save tax now, and that'll be the capital allowances. Now, please be careful about what you're putting in here. You're putting in, I'll put in brackets underneath, the cash value. We want to know how much tax are we saving because we have the capital allowance. So we'll come down to our working one, capital allowances. Your capital allowances you're told in the question are 20% straight line per annum for the 5 years. So that's going to be 750 times 20%, which is, just my calculator, 150,000 per annum capital allowance. Now, you have to be careful there. It's not the 150 that goes in above here. The logic of why it's not the 150, if that's not actually the cash you save, you're really only allowed to reduce your taxable profits by 150. The cash value is the capital allowance, 150, times the tax rate, which is 25%. So that means the amount of tax you actually save each year is 37,500. Tax saved each year. The 150 reduces your taxable profits, and the actual tax you saved in is a plus 37.5 because it's a saving. So that's going to be a positive figure. So you spend 750, but you get these in each year as a tax deduction. Now just bear in mind here, in the reading of the question, a student, now I'm following the suggested solution so you're no confusion, but if you're looking in the question itself, it does say taxes paid in arrears. So that technically means if a student said, well actually you only get the benefit from year 1 and year 2, because that's when you pay the tax, that would be acceptable as well. So if you had a 6th column just for the capital allowance, that will get full marks. We're just following the suggested solution here, so both would have got credit there. But technically, having the 6th column and pushing these out one would have been the more accurate answer. So what we do then is we have the capital allowance, then we get our cash flows. So all we do is tot them up. So pretty straightforward. And these are the cash flows we're going to use to discount. Now, just to bear in mind, and this is an important learning point that the examiner explicitly said in their examiner report, a lot of students miss the point here. This is an annuity. So instead of going out and doing each individual cash flow and discounting each individual cash flow at the after-tax cost of debt, you could realize here, to get the present value, you're going to have times 0. This is still going to be minus 750. And you're going to get an annuity factor for the 37,500. That is going to be a 5-year annuity factor. It's a 5-year annuity, and we have to figure out at X%. And that's where we're going to now. We have to figure out what is the after-tax cost of debt. We're told here the cost of debt is 8%. You only use the cost of debt for buy versus lease. You don't use the cost of capital. That's only for normal NPV. And the tax rate is 25%. So it's going to be 0.08 times 1 minus t, which is 8 times 3/4 is 6%. So your discount rate there is going to be 6%, which is your after-tax cost of debt. And that is how a buy versus lease is done. So we now need to go to our annuity tables to save us doing them each individually, getting a 5-year annuity factor at 6%. So you should have some tables with you. I'm just using an appendix from CAP1 Finance, which is valid if you've gone through that route, but any of the tables should be fine from your book, etc. 6% for 5 years is 4.212. Now, as I said, you may be using, it might be slightly more complicated if you did it in arrears. We're following the suggested solution. It's a 5-year annuity, so you multiply the 37,500 times 4.212. That's a shortcut way of getting the present value of all those 5 cash flows. So that means the net present value there in PV for the buy option is minus 592,050. Now, we know it's negative, but we expect them to be negative because we're not looking at the actual cash flows it's bringing in. We're really just looking at the financing cash flows. Similar for the lease option. So I'll bring it down here. Your lease option then, the cash flows related to that, just be careful now. You're told here in the lease option that 5-year lease, annual payments of 170, payable in advance. So that's going to impact your time value of money. So here you're doing 0, 1, 2, 3, 4, and 5. You're paying this in advance, so it's minus 170. But just be careful, you multiply by 1 minus t. Because that lease payment is tax deductible. Because it's a valid business expense. So the true net cost to you for buy versus lease will be 127,500. That is the after-tax cost of the lease payment. So you can do those as 2 separate ones as the solution has, or you can do it similar like this for tax purposes. So either way is fine. We'll keep it similar to the way the solution has it. So we'll look at the minus 170 on its own. You pay that for 5 years. And the tax saving then, and this is why it's important, the tax saving is at the end of each year, because you only pay tax at the end of the year. So you're going to get 25% of the 170 back. And notice there now you have a slightly different issue because you'll have to have 2 different annuities. The reason you can't net them off and look at a single net cash flow here is because this starts at year 0 and ends at the end of 4 because they're paid in advance. You won't pay tax until the end of each year, so therefore it only starts at the end of year 1. So we get the present value of this annuity and you get the present value of the annuity here. It's quite a tricky question. You had to really understand what annuities are about. So the present value here would be minus 170 because you don't count the first one, and annuity only starts at the end of the first year. So the first one really is just the cash flow as it is, plus minus 170 times the annuity factor now for 4 years at 6%. So that's a tricky one. You can't say it's a 5-year one because an annuity assumes it starts at the end of the first year. So what you technically have here is an upfront payment and a 4-year annuity at 6%, which is 3.465. So that's the present value of that is minus 759,050. Just remember where it comes from again. That's a separate cash flow and you take off the 4-year annuity. And the present value of this one then is a simple 5-year one because it starts at the end of year 1 because tax is paid at the end of each year. So that's 6% times 5 years is 4.212. And therefore the net of those together, because you're looking at them net, is 580,000. And that compares favourably to the 592 negative, which is the buy option. So there is a bit of work involved there. You have to figure out what the after-tax cash flows are, the financing cash flows only, and then particularly in this exam question, the examiner was looking to see, do you know what annuities are? Basic time value of money coming from CAP1 finance. So it's important to go back over it. The conclusion here is both are negative, we know, but that's because we're looking at a specific application of NPV. The one with the least negative one is the lease, so that one looks the most financially attractive. They should lease the equipment. The second part of this question was to do with critically analysing or assessing the investment appraisal policy and suggesting 2 changes. This is an examiner favourite since 2018 and 2017 papers of seeing the students understand best practice investment appraisal, not just the numbers, which was part A, but also the approach to it. So their approach here is to assess the project by calculating the IRR and determining whether that IRR exceeds the cost of debt. So you're not given much more information than that, but what you're told here is to critically assess means what's good or bad. Well, the first thing what's good is that they do use the cash flows and they do calculate an IRR. So that is a good approach. So that word critically is important. So it's good that they have a policy. So there is an existence of a policy, which is one positive. And the fact that they use IRR, that's a relatively good metric. Now, in terms of a drawback, well, number one, they use the cost of debt. Regardless of how a project is financed, usually the best practice is to use the cost of capital of the firm, to include some element of equity, because remember, the cost of debt is always going to be lower than the cost of capital of the firm. So that means you may be artificially having a too low of a discount rate when assessing projects. So number one is a limit. Cost of debt really shouldn't be used. It should be the overall cost of capital. And internal rate of return on its own has limitations. It should really be used at least in conjunction with NPV. So your two recommendations, you've already discussed them. Use cost of capital instead of cost of debt. And try and use either NPV as well as IRR, or if you're only going to use one, use NPV, because it's much better at capturing the scale, and IRR suffers from some calculative limitations as well, that you can have multiple IRRs for one set of cash flows, just the way the interpolation formula works. But it's only 5 marks, 1 mark each for the 2 of the changes, and 3 marks to critically assess. So watch for the phrasing and watch for the lines that are highlighted. Critically and the and, because there's 2 parts to the requirement. So just to show you why that was important that year, if we go to the examiner feedback, it's not a red page. So you look, the general feedback that year of the overall paper was that the examiner felt candidates appear to be focusing on some areas of the competency statement to the exclusion of others, and one of the examples they used was leasing versus buy. That the examiner felt that students had cherry-picked, left out those areas, and they said ignoring parts of the statement, competency statement that is a very high-risk strategy. That was in Autumn 18. The examiner knows this is on students' agenda to try and narrow down the syllabus. Everything is examinable. And we've seen that trend particularly with CAP1 finance. In specific to the question that we're looking at, the feedback from question 3, question 3 was answered very poorly, least popular question, and mainly it came from the lease versus buy. Candidates were not comfortable with discounting annuities, so a lot of them did the 5 years cash flows multiple times. You might get the same answer and you get full marks, but you'll waste a lot of time. So you need to know, and this will be on the examiner going forward as well. Best part answer was critically assess the investment appraisal policy. So candidates generally were good on that, but they were poor on lease versus buy, which was 7 marks. So make sure you go back and look at the examiner feedback each year. Whatever the examiner is not happy with, it's going to be re-examined again. Maybe not the exact same question, but similar enough areas. So that was Autumn 18 question 3, focusing on CAP1 finance.